Hello, this is Javiercito or Javi. Today we're going to be talking about one of the most common home buying myths out there, and that is you can only buy a house if you have 20% down. Now, I'm going to save you probably about 15 to 25 minutes of your time and just give you the answer. No, it's not true, and you probably already knew that. You know there's 3.5% down programs, 5% down programs, even 0 down percent programs. Instead, what we're going to focus on this video is the myth of only smart home buyers put 20% down, meaning anybody who doesn't put 20% down is a big dumb caveman like me. So let's talk about that myth and really get into why people say that, talk about the pros and cons, and really have a deeper understanding of how this works. A lot of numbers going to be thrown around, so I'll do my best to have infographics and calculators at hand. So, oh, and by the way, my name is Javi. I make videos like this to help empower and educate you on the home buying process so you do not get taken advantage of when you're buying a home. And if you are looking to buy a home soon and you're in the Phoenix, Arizona area, hit me up, bro and sis. Or if you're not in Phoenix, Arizona, just look at my referral network below. Have a bunch of other cool tools there for you to check out as well. But anyways, let's get to it. Buying a house with 20% down is only what smart home buyers do. Where does this originally come from? Well, first and foremost, let's clarify what it is. 20% down means that you're probably going with a conventional loan. When you're buying a house, there's a bunch of ways to buy a house, but there's two main ways to do it. The majority of people do, or actually three. One is going to be a conventional loan, and the second one is going to be an FHA loan, or Federal Housing Administration loan. The other ways are cash, VA for veterans, USDA if you're in the middle, out of nowhere. There's different options, but usually those two are the main big enchiladas. When we're talking about 20% down, odds are you're probably referring to a conventional loan. Yes, in theory, you could put 20% down on an FHA, you could put 20% down on a VA, but you're kind of throwing your money around for no reason there. People go FHA because of the low down payment, right? It wouldn't make sense to go with FHA and say, hey, I'm going to put 20% down as well. It's like, why? Just go with conventional. 20% means conventional loan, right? 20% down. So why do people do this? Why do smart people do this according to the myth? Well, the reason is if you put 20% down, some things happen with the loan. You're going to get rid of your mortgage insurance. So what is mortgage insurance? So let's just do a quick little role play here, okay? Let's say you're buying a house for $500,000. So you're putting 20% down, which means I'm loaning you $400,000. The agreement that you and I are making is like, hey, you're going to give me a little bit of down payment and I'm going to give you all this money, but I'm going to charge you a lot of interest, and I'm going to not only make my money back, but I'm going to make my money back with a lot of interest over time, and I'm going to make more money eventually, right? But of course it carries a risk, and how I make myself feel better with that risk is with mortgage insurance. So the mortgage insurance is a monthly payment that you as the buyer make, that protects me from you. Right? So let's say it's $100 a month, right? You're paying $100 a month for an insurance. And what this insurance does is if you ever foreclose or you let the house go and you stop making payments, that insurance kicks in, takes the house, and gives me, the bank, some of my money back. I don't know exactly how it works. I don't think you get all the money back, but at least gives me most of my money back. That way I'm protected, right? So my investment is insured. So now me as the bank, when I'm selling your mortgage and with a bunch of other mortgages, it's insured. So people can invest into me feeling more secure because these are insured. That's how it works. You're basically paying an insurance to protect yourself from the bank from you. I know, kind of weird. So with 20% down, you're getting rid of this entirely. You're no longer deemed a risk, a flight risk. Like I've been watching too much The Wire. Have you ever watched The Wire? Great show. They're like, hey, you're putting 20% down. You're good, right? We're gonna not charge you that PMI, whatever is needed. The second thing that gets modified with that 20% down is that you are obviously putting $20,000. It's like a lot of money, right? So technically, just an average rule of thumb, every $10,000 is about $50. So if you are buying like a $500,000 house and you're putting $100,000 down, so you're saving just $400 just like that off the bat. And on top of that, in theory, you should be getting a better interest rate. But the reality is it probably still won't be as attractive as FHA. I know it doesn't make sense, but you putting 20% down probably, at least things are the way they are now, you're probably getting still a higher interest rate than if someone's putting 3.5% down using a government-backed product. I know it's weird, but it's just the way it works, unfortunately. And the last thing I can think of is putting 20% down. For most lenders, gives you the ability to be more flexible with that mortgage. So typically your mortgage is your principal, your interest, your property taxes, your hazard insurance, and your mortgage insurance. Well, in this case, you have no mortgage insurance, and that hazard insurance and those taxes, what I've seen from lenders is they're willing to let you take care of that, right? So that they don't have to take that from your mortgage. So you can kind of separate it out. You pay your taxes by your own, you pay your insurance on your own, and your principal and interest is just your mortgage, and that's what you pay on your own. I will just be cautious on that. Sometimes they don't let you. It really depends on the mortgage and the lender and the rules and everything. So please double check that just to be sure. Okay, so now that we have a base understanding of why people say it's smart to do with 20% down, let's delve a little deeper on if it really is smart. So when you're looking at the mortgage insurance, right, and people say, well, gosh darn it, I'm putting 20% down just because I don't want this damn mortgage insurance. Well, yeah, they're comparing that to somebody who's like maybe going with FHA, right? If you're going with FHA loan, which a quick refresher, FHA is 3.5% down. Your interest rate will be lower with FHA, at least how things are now. That can always change. But the two major problems with FHA is you get hit with mortgage insurance twice, okay? So FHA will hit you for 0.55% of your loan amount as your insurance, your mortgage insurance monthly. So that sounds complicated, but let me pull out a calculator and let me just show you what I mean by that. So let's say you're buying, once again, that $500,000 house. So we'll type in 500,000 and we find out what our loan amount's going to be. So we take away the 3.5% down that would be with FHA. So that would be what, 0.965. So your loan amount is actually for 482.5. So once you get the loan amount, you multiply this by 0.55. So it'll be 0.0055. Okay. Whatever that number is, you divide that by 12, and this is the number they're going to hit you with for the rest of your life. Whatever your starting loan amount is, you do that formula I just taught you, you get this number. Now your mortgage payment, principal, interest, taxes, hazard insurance, will have $221 there forever. For 30 years. Yes, there's special exceptions where you can get rid of them if you put like 10% down or something. There's ways. People always want to correct me on that because they feel like special doing that. But most of the time, 98% of the time, it is permanent and forever. So you will always pay $221. And why people do that is because the interest rate is much lower and the down payment is much lower. So it's like worth the risk, if that makes sense. So you're paying $221 on your mortgage payment for 30 years. Multiply it by 12. Multiply that, let's say in 10 years, that's $26,537 of just a mortgage, mortgage insurance that you're paying per 10 years. What can you do with $26K in 10 years? So let's just do another example so you know. Let's say you're buying a $350,000 house. So we get that number, we figure out what the loan amount is. So we take away 3.5. Then from this number, we get 0.0055, divide that by 12, and that gives you the amount that they're going to be charging you for the rest. And once again, it's the first loan amount. It does not change periodically. You will pay 155 in this case, 154.8 for 30 years on your, unless you refinance or you sell the house, of course. You got to worry about that monthly PMI. But on top of that, they're going to charge you an upfront PMI. So let's say you're buying that $500,000 house. So you would think in theory, when you close on the loan, that your loan amount would be 482.5, right? But they're going to charge you that upfront PMI, and they're not going to charge it to you now. They're just going to add it on the loan balance. And that amount is going to be 1.75% of this amount. So going to multiply this by 0.0175. So it's 1.75. And I get that number, 482,500 plus that upfront mortgage amount. So my loan amount will be 490,000. And you'll pay that when you sell the house because you're going to have a higher loan amount because the loan amount has to get paid when you sell the house, right? So all that to say, when they're talking to you about like, well, I want to get rid of my PMI, they're usually comparing that with FHA, which has the double slap. It has, like, if you saw for 450, 500K, it's going to be over $200 a month. Or if you're buying like 350, it's like 150 to 200, right? So yeah, it sucks to pay that extra $150 to $200 But at the same time with FHA, your interest rate's like much lower. So you have to kind of account for the cost difference of that. But one thing to also keep in mind with conventional is if you're putting less than 20%, let's say you put 10%, 5%, 15%, that mortgage insurance is going to be dependent on your credit and your down payment and your overall profile. So if you're somebody who's buying a house with conventional and you're putting 5% down, but you have excellent credit and excellent history, you might see that mortgage insurance be really low. You might see it being between $40 to $80. So you shouldn't really compare that, oh, I'm going to put 20% down so I can get rid of that PMI, bro. But what if you were to do 10% and you have great credit, so your mortgage insurance is only like, I don't know, $30, $50 a month. $50 a month, you multiply it by 12, you're talking $600, right? Is it worth to put extra 10% to save $600 a year? You kind of have to run the numbers, right? So yeah, paying off that PMI is really nice and really sweet, but when you already have good credit and you're in an excellent position, why not save that liquidity and only put 10% down and pay that extra whatever PMI is going to be? And now here's the beautiful thing about conventional. It doesn't matter if you start at 5% or 10%. Eventually, once you've paid off around 20% of your total loan amount, then you can get rid of that PMI anyways. So it just makes you think. I'm not telling you there's a right or wrong here, but you know, if you're somebody who's buying a house and you have nothing, you have, let's say 25% of the house. So let's say you have $120,000 in your bank account. You're buying a $500K house and you're going to spend $100,000 just so you can, do the 20% down and get your daddy's approval finally. By the way, you're not going to get his approval. Trust me, I've been trying for 32 years. So you get left with $20,000 and you're in a tight spot there. So what if you were to only put 10% down and now you're left with $70K in the bank? A lot more liquidity. What did it cost to get those extra $50,000 in your bank? Well, let's calculate that. So let's say you have excellent credit. So your PMI is maybe only about $50 a month, right? So $50 a month, right? And then it's $50,000 less you're putting in down. So let's assume every $10,000 is about 40, right? So it's going to be what, 200? So overall, you're saving $250 a month, rough numbers based on you having excellent credit. Okay, so $250 a month, $3,000 a year. So you put an extra $50,000 so you can save yourself $3,000 a year. It's going to take you 16.6 years to break even. So once again, I'm not here to tell you there's a right or wrong. I'm just here to enlighten you. The second thing is you commonly will think that you're getting better terms because you're putting 20% down. And as I said earlier, that should be the case. In my opinion, if you're putting higher down payment, you should be getting better terms. But honestly, your interest rate will not be as low as you go with just FHA, which is unfortunate because you're putting a lot more money down. But the terms aren't really quite there. So once again, I challenge that. Like, what if you were not to go 20% and you only go 10%? But then maybe you use like an extra 2 or 3% to buy the rate down to where the FHA should. There's just different ways to use that money, right? There's like, it's not just a very finite rule where it's like 20% down, ooga booga, this is the way to go. No, set yourself up for success. Like, to me, this is just everybody's philosophy is different. To me, I would rather hold on to those extra 10%, like $50,000, and put that in an account somewhere. Like put that in your college funds, put it in an investment. I don't know, do something else with it, and then putting it in your house and saving yourself a few $100 a month. That money, when it puts into your house, it's frozen solid there, baby. Right? It's frozen there. And if the market goes down, it's gone. If the market goes up, it's still there, but really the equity is what's growing, not that money, right? Think about it like this. When you sell your house, let me just kind of break down how it works traditionally to sell a house. So then what is truly the value then? Like, what was the point of doing that? Well, there is something that might help. Let's kind of calculate this and figure this out together. So if you were, let's say in scenario A, you put 20% down. So it's what was that? $400,000 loan amount. And let's say your interest rate is, 6.5. And you sell it 10 years later, so in 2035. Your principal is going to be $333,466. And you paid a total of $257,085. If it was the other way around and we only put 10% down after 10 years. Clearly the principal will be different. That's going to be obvious. But one thing to note here is you paid about $30,000 more of interest with this situation. Why is that? Well, the reason is because there's a lesser loan amount. So I guess you feel better because you paid less interest in the span of, what is that, 10 years. So you paid less interest total. So in conclusion, I would say this myth is busted. It's not true that only smart buyers put with 20% down and everybody else who's buying a house under 20% is a big old dumb caveman. It's not the case. I think personally, it's depending on your situation. Like if you're somebody who has $100,000 in the bank, and you're buying a $500K house and you blow all of your money, but you put 20% down, good job, but you have no money left, then that's not the smartest move. You're left with no money. So it's really dependent on a few factors. How much money do you have currently saved? Right? You never want to blow your entire savings on a house. The second factor is, what is your sense of urgency to move right now? If you're in a situation where, shoot, man, you have to be out because your lease is up like in 2 months and you have $30,000 saved and you want to buy like a $300,000 house, are you going to go and just go find another place to rent and wait until you collect another $30,000 so you can put 20% down? Or do you maybe just go take advantage of a 3.5% down program or maybe a 5% down conventional loan and just get yourself into a house that you own and not completely burn your reserves? It really depends on the situation. I think the way it should be reframed is not intelligent people put 20% down, but intelligent people are mindful of their budget, how much savings they have, and they buy with their brain and not their feelings. The other day I talked to somebody, it was a wake-up call for me because remember there's a running joke on this channel where I bought a Tacoma. I got obsessed with the Tacoma a few months ago and I went to go buy one even though I wasn't even financially ready or anything. It was a dumb move. Anyways, laugh at me all you want, but I saw it firsthand. I met somebody at my office that was just like fiending for a house. And even though I told them it's not a good idea to buy right now, that was like a debt situation, or if you were to buy, your interest would be really high and they wanted a specific price point. One of them was just like, I need this house. I need a house, to the point where like they were out scheduling showings without me and they were just going. And they probably are going to get into a house. But I told them, if you buy a house, it's going to be like over 50% of your income. Like you go buy something cheaper, because they really wanted a horse property. They needed land. Because once again, you think with your feelings, not your brain. And like, do you really need land? But anyways, they had an idea that they needed horse property, they needed land, but that payment was going to get them over 50% of their income. And it was just going to be bad news. And I told them, hey, if you want the horse property, great, pay off some debts, do this, do that, then you're going to be in a much better position next year or in like 6 months. It wasn't that long, but she was just like, house now. And I don't know if they went, who knows if they ended up going to go buy, but people think with their feelings, man, not their brains, and it gets them in tough spots. And, next thing you know, they're getting foreclosed on in 5 years. And it's kind of just a snowball effect, right? You don't want to, not everybody has the ability to just go make a bunch of money right away. So don't put yourself in that position where you're costing your future self stress, like, and not going on vacations no more. You can't afford to go out and eat no more because you have this beautiful house. Like, think with your head. Okay. Have you guys ever had that moment where you're just like, I need something right now? For me, it's, I need a commander deck. Like, there's a commander deck. I think I have like 2 or 3 of them and I've really burned through them so much. And I'm like telling my CFO / my wife, hey, I need to buy this $120 commander deck from eBay now. I need it. It's like, no, you don't need it. Chill out. Do you guys have any myths that you might have heard of that you want me to address in the future episode? Please let me know. I'm looking forward to making that video. If you're looking for an agent anywhere in the country that's not Arizona, homeandmoney.com/Javier. Go, you click a few buttons, you click a few blah, 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 type your city, and next thing you know, you got yourself an agent. Also, if you're looking for some home buyer resources like spreadsheets and a bunch of cool PDFs to help you get started, some videos I've crafted, check out my Home Buyer HQ. You can download it on the link below. You name the price. If you are a little tough right now, you're like, hey man, I need it free, then do it free. If you're like, bro, I'm balling right now, here's $5, do what you want. Either way, I appreciate you and I help you. Thank you for your support. And if you're still watching, what's the name of this t-shirt? What is it referring to? Comment it below and you'll get a love emoji from me in the comments. Thank you guys. Appreciate you.